Picture this. You borrow $20 from your friend Alex so you can grab a last-minute snack. Alex says sure, but tomorrow you owe him $21. That extra dollar seems tiny, but it decides who becomes rich, who stays stuck, and why your bank keeps smiling whenever you walk in. This tiny number, the interest rate, silently shapes everything from your student loans to global recessions, yet almost no one explains it in a way that actually makes sense. So today we fix that. Interest rates are simply the price of borrowing money. If money were a product on a shelf, the interest rate would be the price tag. When the price tag is high, fewer people want to buy. When the price tag is low, everyone rushes in and empties the shelves. Economies work exactly like that. Imagine you run a lemonade stand. You want to expand, so you borrow $100 with an interest rate of 10%. That means you will owe $110. If your lemonade business is booming, you make enough profit to comfortably pay back the extra 10. But if sales suddenly crash, that same $10 becomes painfully expensive. This is the real reason interest rates matter. They change how risky borrowing feels. Here is the first truth no one explains simply. High interest rates slow everything down. When interest rates rise, buying a home becomes harder. Credit card debt becomes heavier, and businesses cancel expansion plans because borrowing feels like lifting weights with oil-coated gloves. Fewer people borrow, which means fewer people spend. Less spending means companies earn less. Less earning means fewer jobs. Like dominoes laid in a neat line, one small push starts falling everything. Now the second truth. Low interest rates speed everything up. When interest rates fall, borrowing becomes cheap, and suddenly buying a car, starting a business, or taking a loan for college feels much more manageable. People borrow more, spending increases, companies grow, jobs appear, the economy starts sprinting. But here is the catch. If rates stay too low for too long, you get inflation. Too much money chasing too few goods is like too many kids chasing the last slice of pizza. The price goes up simply because everyone wants it. Let us break inflation down with another simple picture. Suppose a bakery has 10 cakes and 10 customers, each holding $10. Price stays stable. Now picture 20 customers rushing in while the bakery still has 10 cakes. They start bidding. Prices rise. That rises inflation. And low interest rates feed that chaos by making money super easy to borrow and spend. This leads to the third truth. Central banks use interest rates like a thermostat. If the economy is too cold with unemployment rising, they turn the thermostat up and drop interest rates. That warms things. If the economy is too hot with inflation rising, they turn the thermostat down and raise rates. That cools things. It is not magic. It is simply controlling the cost of money to keep the economic temperature comfortable. Here is where it gets interesting. People think central banks create interest rates out of thin air, but they only directly control the short-term rate, which influences how banks lend to each other. Everything else, from mortgage rates to car loans to business credit, reacts to that decision like a ripple effect in a pond. One change at the center spreads across the whole economy. Let us illustrate this with a chain reaction. The central bank raises its rate. Commercial banks see borrowing become more expensive for them. They raise the rates they charge you. You decide not to take that loan. The car dealer sells fewer cars. The manufacturer cuts production. Workers get fewer hours. Those workers buy less, and the economy slows. One tiny move creates a wave that touches millions of people. Now here is the fourth truth. Almost no one spells out. Interest rates do not just affect borrowers. They affect savers too. When rates rise, savings accounts pay more. Bonds pay more. Retirees cheer. When rates fall, saving feels pointless because your money grows at a snail's pace. People shift toward riskier investments. The stock market starts dancing like it drank 3 cups of coffee. Here's a quick example. If you save $1,000 at a 2% interest rate, it becomes $1,020 in a year. Not impressive, but at 8%, it becomes $1,080, still small, but much more motivating. Multiply this effect across millions of savers, and you get huge shifts in where money flows. Let us tackle a final truth. The real danger of interest rates is not that they go up or down. It is that most people make financial decisions without understanding how they work. When rates are low, people borrow too much. When rates rise, they panic. When rates fall again, they repeat the cycle. It is like eating junk food and wondering why your stomach hurts every year. So here is the simple formula the world keeps ignoring. Low rates encourage borrowing and growth, but risk inflation. High rates fight inflation but slow growth. Neither is good or bad by itself. It depends on the timing and the economic situation. To wrap this entire journey into one picture, imagine money as water and interest rates as the faucet. Open it too much and the room floods. Close it too much and everything dries up. Someone has to keep that faucet at the perfect flow. That someone is the central bank. And the secret to navigating your financial life is paying attention to how wide that faucet is turning. Once you understand how interest rates actually move the economy, borrowing becomes a tool instead of a trap. Saving becomes strategic instead of random. And you finally see the hidden logic behind every headline that mentions rate hikes or rate cuts. The truth is simple. Interest rates quietly control the world. And now you finally speak their language.